Welcome to my Wealth of Knowledge podcast on real estate investing made easy. We're going to discuss today the mortgage calculator and how we can go about paying a little bit extra each month or perhaps one extra payment a year to lower our financial burden and increase our equity in our property. In our example, we're going to use a home price of $500,000 with a 5% down. That means $25,000 will be the down payment, and the loan term will be for 30 years at an interest rate of approximately, 7.3. So in this scenario, the monthly payment will be $3,664, which includes property tax, an estimated property tax, some homeowners insurance, and we don't include mortgage insurance, which is typically required if you're putting less than 20% down. So, how much house can you afford is directly related to the type of mortgage you qualify for. So, understanding how much you can comfortably spend on a new mortgage while still meeting your existing obligations is crucial during the home buying process. I do want to emphasize that in this scenario, we're not talking about a single family property, which we would definitely not recommend for anyone seeking to obtain and achieve a financial freedom through real estate. Equity built up through a multifamily will achieve wealth a lot faster than a single family property. So we highly recommend that a first time home buyer skip the single family home and go directly into either a duplex or a triplex. If you can get a four family, for example, that will keep you under the commercial mortgage rate requirements. So that will still enable you to qualify for a mortgage under a residential mortgage and not a commercial. Not sure how much of your income should go toward housing. You should follow the tried and true 28-36% rule. So many financial advisors believe you should not spend more than 28% of your gross income on housing costs, such as rent, mortgage, and that you should definitely not spend more than 36% of your gross income on overall debt, including mortgage payments, credit cards, student loans, medical bills, car loan, etc. So, for example, if you make $60,000 a year, that's a gross monthly income of $5,000 a month. So 5,000 times 28%, that leaves you with $1,400 monthly mortgage payment. And that is pretty much how much you can afford. So at the end of the day, if you're buying a single family, which we don't recommend, that $1,400, that is what you would most likely max out at. If, however, you're buying a multi, then you're going to include rental payments as part of your income. So that changes the game and changes the way the calculations work. Okay, so let's get back to our fictional multifamily home, which was priced at $500,000. You put 5% down, and that means a down payment of $25,000 with a 30-year loan at an interest rate of roughly 7.3%. And your loan amount basically means that you're going to pay $3,664 a month. And if you bought this property in July of 2023, you will pay it off in July 2053 for the total cost of the loan. So you borrowed $475,000, but you will end up paying $1,177,341. So you'll pay an interest, total interest amount of $702,000 roughly. So now we're going to discuss what happens if you make an extra payment either monthly or per year and how that changes the payoff as well as the overall cost of that loan. By making an additional yearly payment of $3,000, the loan will end in 2047 versus 2053 without making any additional payments. So that shaves off roughly 6 years on the life of the loan and a substantial savings in the long run. Another example is that if you make an additional monthly payment of $100 on this loan, your loan last payment will be September 2050. So you've now shaved off 3 years by making an additional $100 monthly payment, which can make a huge difference in the life of the loan and in the amount of savings on interest rate payments over the life of the loan. There are several options to consider if you're struggling to afford the home that you have your eyes on. And some methods take time for sure, whereas others can immediately impact your mortgage application. For example, lowering your debt to income ratio is critical. DTI is one of the most important factors that lenders consider when looking at borrowers. And so lowering your DTI by paying off as much debt as possible is a good option. And if your DTI is too high to get pre-qualified for a reasonable interest rate, or even to qualify at all, you may need to get a second job, a side hustle that will help you, pay off your debt quicker. So, what is an optimal, DTI, debt to income ratio? And that is about 36% or below, including, any housing expenses, etc. The next way is to raise your credit score. I mean, there are several ways to improve your score. First, it's important to check that your report is actually accurate with all three bureaus, Experian, TransUnion, Equifax, and make sure that there are no inaccuracies. If there are mistakes in your credit history, you can file a dispute with the credit agencies. They are legally required to address any inaccuracies, and it's important to stay on top of that. And now, in terms of additional income, I mean, obviously, it goes without saying that, a side hustle, a second job, doing something else to bring income into your household, it will better prepare you for that property investment. So that is a critical key part of this. So there are some benefits to a larger down payment, like saving enough money for a substantial down payment takes time. So it does require some advanced planning and patience. So a zero or low down payment requirement may speed up your ability to buy a home, but making a larger down payment has advantages for sure. A better mortgage rate, for example, interest rate. You can establish more equity in your home right away. And it also lowers your monthly mortgage payment and, lower upfront and ongoing fees. So a low down payment is going to require, like I said earlier, is going to require insurance. So just remember that private mortgage insurance kicks in if you have a down payment of less than 20%. But once you reach that 20% equity, then you can cancel that PMI that can take a chunk of your monthly expenses. So there are other considerations, however, in determining your down payment. Your mortgage payment is just one piece of the overall household budget. So with that in mind, obviously there's some other considerations when planning for the size of your down payment. You want to have some money in the bank, for example. Avoid using your entire savings for a down payment. You could end up house poor, so to speak, spending too much of your income servicing your mortgage and depleting your emergency fund. And don't forget about closing costs. That oftentimes is overlooked. It's usually 2 to 5% of the home purchase price. And plan for the ongoing costs of home ownership. I mean, you got to have a cushion for home maintenance and repairs, as well as potential emergencies. And especially if you have tenants, things will arise and repairs will need to be made. And lastly, shop around for the best mortgage rate because they do vary from institution to institution. And but in the end, I think you'll find that there's a lot of good information out there for how to do this. Just remember that financial freedom is definitely achievable through real estate, but you have to be smart about it. Don't forget to like and subscribe to our channel and look out for future videos on this topic and others.